Hey there, folks. We need to talk about a spike in weekly unemployment rates. We need to talk about a recession being officially called. And we might as well talk about the talk track of rising supply really denting rents, and probably close with the notion of renter nation. Lots of stuff going on today. This is your daily financial news for June 8th. And like always on Thursday, we get a little peek into the US economy. We get a weekly reading on US unemployment claims. This is something you and I have been talking about for the greater part of a year. Certainly the last 6 months or so, we've been talking about the Fed likely wanting to see this. I was saying probably close to 320. And at least for the last several months, while trending higher, it's been stuck in the low 200s. Well, we finally had a significant break to the upside. We jumped to a weekly unemployment claims of 261,000. This is by no means a trend, but it is something worth watching because this is where I think things are going. I think the unemployment claims are going up. We saw the unemployment rate go from 3.5 to 3.7. We have more people being uninterested, i.e. U6, moving to U3. They are now actively looking for employment. So again, I think what we are seeing is exactly what you and I talked about 3 or 4 weeks ago, right? Pre-debt ceiling, right? You can go back to the daily financial news and watch these videos, right? We have receipts on this channel. And really what we talked about is, hey, we're going to see higher interest rates until kind of the debt ceiling gets solved. And once that gets solved, we're going to see rates trickle lower. Then what we're going to start to see is softer economic information, ultimately coming together next Tuesday. Again, next Tuesday, 5:30 a.m. Pacific is a big day because we are going to get the CPI headline reading, which I expect to be 4.3 or better. Again, the last reading was 4.6. That will be, I think, the 11th month in a row heading down. I think the July reading will also be significantly lower, taking us into the low, probably the mid threes. Then we get the housing rollover in rents and, things look better, right? As we've talked about, the next 4 months, generally speaking, I think will show inflation settling down. We will see unemployment rising, and we will get again, I'm not calling soft landing, but we will get the Fed pause, which I've been calling for quite a while. And I don't believe we will get a rate cut this year. So all of that being said, it still feels like we are heading towards the Fed pausing. We will then have rates tick down significantly, if I am right, on Tuesday. And then what we will start to see over the next 4, 8, 12 weeks is we will start to finally see that margin compression, right? Today, the margin, I think, between the 10-year and the 30-year mortgage is 320 basis points. You can think of that as 3.2. So take the 10-year, add 3.2, bingo, bango, mortgage rate. That is only interesting when you have context in history. History says that spread should be more like 1.8. So we have, simple math says 1.4 or 140 basis points in margin compression. That is possible once banks start to understand that the Fed is done, the economy is weakening. So again, simply said, everything is going exactly how I expected. We will know a lot more Tuesday at 5:30 or maybe 5:45. But yeah, I think it's setting up to have lower rates. I am sticking with my 6% call, right? High fives, right? 5.9, 5.95, something like that. I am still fearful of 5%. I think that would be unhealthy. And we've already had an unhealthy housing market. We don't need to revisit that. Not that 6% will be much better, but it will certainly be better than 5%. So again, lots of stuff going on. Again, jobless claims 261, expectations were 235. Last week was 233. So again, a significant jump. And again, I think this has to get over 300. I think we're on a path to more than 300,000 weekly claims. And again, what does that get us? Quite frankly, it gets us a Fed pause, which I think is something we would all like. So a couple of things. I don't normally do this, but do me a favor, hit that like button. It does help more and more people see these. I do this daily show live on purpose, no fancy cut in, cut out, all of that. I take copious notes and share my thoughts. So again, do me a favor, like, subscribe, comment. Normally do this at 7:30 a.m. Pacific, except on Thursdays because one of our millionaire guests needs to record early. So I just do this earlier for you. So hopefully hopefully you appreciate that. That would be great. Let's talk about this notion of renter nation. The doomers out there are really pushing this idea that, the world is crumbling and the U.S. economy is going to be a renter nation and the this and the that. And nothing could be farther from the truth. The doomers don't like information. The doomers want to take a talk track and don't back it up with facts. Let me give you an example, right? Renter nation. Did you know that home ownership, right, which is a percentage, home ownership has been on a 7-year climb. There are more homeowners today than there were any time of the last 7 years. Also, something you could do is you can go to my website, onerentalatatime.com. The bottom right box, there's a download. You can get the download of my 53-year spreadsheet. You can go back and look at home ownership for the last 53 years. And you will see that today's rate of 66% is in the higher quartile of history. In fact, the only time that we were higher was in the 05, 06 that I can recall, and that was unhealthy, right? That was the no-doc loans, the liar loans, all of that crazy stuff. So again, we are at 66%. We are at a 7-year high, right? It's been trending up. So this notion that renter nation is possible is just for the lazy. It's just for the doomers. And I'm not telling you it's easy. I've never said this game is easy. I've told you it's worthwhile. People who make real estate investing seem easy annoy me. It's never easy. It does take work. It's just, if you how bad do you want it? And oh, by the way, it's slow. The first 5 years of being a landlord suck. It's just, you get a trickle and something breaks and you're frustrated. It's just, it's the system testing you how bad you want it. So again, just renter nation is not happening, right? If renter nation was happening, we would be going the opposite direction, not on a 7-year trend higher. So again, don't believe the doomers out there. I want to call your attention to 2 very important videos that posted yesterday that some of you may have missed. One of them is from Matt the Mortgage Guy. Matt the Mortgage Guy shared with us that getting what's called approve eligible, right? Basically, it's an online system mortgage brokers use to put in the criteria of a home buyer. It's getting harder. It's harder today than it was months ago. What does that mean, harder? Well, it just means that Freddie and Fannie, I certainly could talk this morning, aren't as open to buying loans, because that's what approve eligible means. These are banks sending loans to Fannie and Freddie, and the approve eligible means that they stand ready to buy. So again, if it's getting harder to get loans done, we just need to understand that. And again, if you saw my 20-minute talk about what's coming, I tried to warn you that getting loans is going to get harder. Today it's a 4, and we're probably going to an 8 or a 9. And again, this is just more evidence. I actually think it's probably easier for investors today because we still have the appetite of non-QM lenders and the like. So it's really interesting to see that homeowners are having a harder time. But again, we need to stay up to date on this. Also, the doomers are out there talking about supply, right? All these apartments coming online, which is very, very interesting. We should watch that. But I also want to tie that conversation to what's going on with the lending market. Something you heard me talk about with Lance Lambert from Fortune in a great follow on Twitter is private builders. These are not the publics. This is not Toll, not Lennar, not Pulte, not those guys. But the private builders are going to start retreating or shutting down as they can't get funding. This also plays for apartments. So again, there's an article, or at least a tweet storm by all the doomers talking about apartment expansion. And I have some numbers. I have the top 5 cities for you. We'll go through and then we'll talk about the bigger picture. So Nashville, has the largest supply of apartments coming online. So if you're an investor in Nashville, you should pay attention. There's over 10,000 units coming online in the next year and a half. Right, this is through the rest of 2023 and 2024. For folks that don't invest in Nashville, what does that mean? That means about 36% increase in units, according to this article. Salt Lake City has 6,400 units coming, about 29% expansion. We have Phoenix at, call it 4,000, again a 29% expansion. Charlotte 5,300, 25, and then finally Philadelphia at almost 10,000 with 21%. So what does that all mean? Well, again, in the short term, you have more supply. They're obviously majority, I would assume, Class A. But let's not forget that commercial banks, which were the, source of construction financing for most folks, is gone. I suspect what we are going to see across the country is a significant drop in groundbreaking. I think earlier in the week we talked about, I think it was 48 of the 95 projects that were in pre-construction or just broke ground stopped. You guys, I don't think the general folks really get a feel for just how much liquidity is drying up and what that will mean to supply. We are going to have less new homes. We are going to have less apartments. We are going to have less of everything. So again, be warned what's coming. It's pretty obvious. You probably see the cranes and all of that. But we are going to have a huge air gap in the timeline as this liquidity crisis won't be over anytime soon. So again, just pay attention. Don't be a doomer, but realize what is going on out there. So again, I think the supply that's coming in 2022, 2023 is real. But we are going to see a big drop in 2024 and 2025. So again, just pay attention. Be careful. We talked about 550 California Street. It's an office building in San Francisco a couple of times. Well, it looks like we have done a final accounting, and it looks like Wells Fargo will be taking roughly a $60 million loss on 550 California. Again, this was an office building that went up for sale. Equity was wiped out, but also the bank, the lender, will be taking a $60 million haircut, I'm sure. That is not fun. Eurozone, we talked about a recession up front. It looks like the Eurozone is officially in a recession. There were some numbers that came out this morning. Not only is Germany in a recession, which you and I reported on, I think, last week, now the Eurozone proper has been declared in a recession. And, oh, by the way, let's not forget, they still have very high inflation. So kind of a stagflation economy, not fun. Lots of pain, I'm afraid, for my folks that operate in Europe. Another video that came out yesterday that you should pay attention to, especially if you are in certain markets, was a conversation with Brian Adamson. Brian Adamson is a out-of-state investor, right? He lives in Florida but invests in Detroit, Michigan. He shared a critical conversation about Section 8 or affordable housing. And simply said, affordable housing is where the government pays some, if not all, of the rent for folks that have a certain income limit. There's more to it, but that's a simple discussion. And what Brian is telling me, at least about Detroit, is the number of landlords who have opened their units up to accepting Section 8 has exploded. I believe most markets is still supply constrained, but this is something we need to work on, or we need to watch, right? If you are in a market where landlords basically say, hey, I got burned by cash tenants. I don't like these eviction moratoriums. I want to get some guaranteed Section 8 income. You could turn your units over. Now, all of my units are available, but again, a lot of landlords have a predisposition to say no. That is on them. I think it's a wonderful program. But if they suddenly switch and they go, okay, take my units, you could run into a supply problem. So the folks in Detroit are actually doing kind of move-in specials, right? Free TVs, waiving down payments, things of that nature. So again, as landlords in your market, your buy box, make sure you have a rent box. You know what's going on there. Shout out the Lumberjack for his rent box idea. just again, keep doing the work, keep networking, keep understand what is going on in your market. We did get a couple of earnings that we need to at least acknowledge. One was from Singit Jewelers. They basically said they had a weak Mother's Day, and they have lowered guidance going forward. Again, jewelry is one of those, I don't know, I'll call luxury items that are easy to cut back on, so not a surprise. And then there was HashiCorp. I do not know what they do, so I looked it up. They are an infrastructure automation company, software company. And remember what I've tried to warn you about the last 30 or 45 days. Software companies, X cybersecurity, and maybe X AI are in for some trouble. And HashiCorp is just another example of that. And they've gone out to cut 8% of workforce. So I think there are some layoffs coming to software companies as they right size for their future income stream. So lots going on. I do want to talk about something I announced yesterday that had some pretty good response. So thank you all for that. Yesterday, I announced that if you buy my course, How to Get Started One Rental at a Time, for $3.99, I will give away 2 of my $50 courses or $47 courses, your choice. Or if you buy your Get Your Money Right course, I will give you 1. Right, the Get Money Right course is only $99. Some of you reached out to me and says, Michael, I don't see a bundle code or how to do that on your website. I don't know how any of this stuff works. So what happens if you buy my course, How to Get Started One Rental at a Time, or Get Your Money Right, I will get an email, and then I will respond manually asking you what you would like, and I will add you manually. I'm sure there is a way to do it online or with systems. I have no idea how to do that stuff. I'm just going to do it manually. It also allows me to send an email to you thanking you for your purchase. So if you want to do this still, you can do it. I know some people waited because they thought there was a bundle code. Just buy the course. I'll get an email. I'll send it back. Everybody who bought yesterday, I did send you an email. And you just tell me what you want, and I will manually add folks today. I did not do that yesterday. We were out and about all day. But thank you for that. Again, might as well do this. Again, if you want to buy the course, you can do that and get 2 free $50 courses, which is pretty cool. What else is going on? I don't know if you saw this, but GameStop fired their CEO. And there was no reason given. I can tell you a reason. He didn't use the capital, and he just kept banging the shareholders with selling more shares and just doing all of those things. So that wasn't very, very cool. And then the last thing, rents. So we clearly saw rents fall, and that's something I'm counting on to bring inflation down. But I have some things that we got to watch. Again, John Wake, again, a wonderful follow on Twitter. Shout out, John. John Wake showed a chart on Twitter. Again, give him a follow so you see this stuff. Rent growth for the country, up 0.9% year on year. Arizona is down 3.4%, which is where John covers. But as someone who was worried about inflation kind of coming back or rearing its ugly head, seeing rent growth come back, we got to watch that. Now, 0.9% is not a concern, but if you look at the chart, the trend is not your friend, if you know what I mean. And then lastly, Manhattan. Manhattan's rents are up again. They are up 10% year on year, up 3.6% month on month. As someone who has talked about San Francisco dying and more people walking away from office and hotels, it is very interesting to see that Manhattan is not seeing that, frankly. That just goes to show you that maybe there are some things in San Francisco, like government decisions and the like, that are really driving the behavior. And we've talked about that on this channel for a long, long time. So at the end of the day, folks, I wanted to thank you for watching this. You all make this fun to do. I really enjoy doing these. Hopefully you appreciate that they're live. We will keep doing these. And like, subscribe, comment. Remember, we are trying to get to 50,000 subs. And once we do, we will start planning an event in Vegas. So yeah, have fun. Take care of yourself. Have a wonderful day. Bye.